Welcome back to another episode of the $100 to $10,000 series, where I invest $100 every month to the Vanguard S&P 500 ETF until it grows to $10,000, to show everyone that you don't need a PhD or be a millionaire to invest successfully. This week, we're up 1.21%, and overall, we're up 12.15%. Also, from now on, I'm only going to do the portfolio update every month instead of every week. And in this video, I'm going to talk about how President Donald Trump was able to avoid paying taxes for many years, and how you can take advantage of similar systems in place. Before we discuss why Trump didn't have to pay millions in taxes, let's talk a little bit about how taxation works. Let's say you invested in a stock, and after a few years you want to sell it. Typically, you have to pay taxes on the gains you made on your investment, and this is called the capital gains tax. And investments that were made and sold in less than 1 year are usually taxed at a higher tax rate, which is called the short-term capital gains rate. And this is basically taxed as a part of your income. But if you hold on to the stock for at least 1 year before selling, your investment will be considered a long-term investment and taxed at a lower tax rate. And this makes a huge difference because you might end up paying the government up to 37% in taxes on your short-term gains. But if you hold on to your investment for at least 1 year, the maximum tax rate that you'll have to pay is only 20%. Let's do a quick example. Let's say you invested $1,000 on a stock, and after holding the stock for 9 months, the value of your investment went up to $2,000. Then if you decide to sell your stock at that moment, when it hasn't been a year yet since you invested, that $1,000 you gained will be taxed as a part of your income. And let's say for this example, you are single and making $50,000 in a year. Then you are in the 22% income tax bracket, so you will pay $220 in taxes for your gains if you were to sell your stock at $2,000. But let's say that you hold on to the stock for another 3 months, and now it's been a year since you first bought the stock. And for simplicity's sake, let's assume your investment is still valued at the $2,000. Then now, when you sell the stock, it will be considered a long-term investment, and you will only be taxed at the long-term capital gains rate. And for this, we'll only have to pay the 15% rate since we only make $50,000 in a year. So instead of paying $220 in taxes, you'll only have to pay $150. But going back to the main topic of the video, how did Trump not have to pay any taxes when he owns so many businesses? Obviously, his tax returns are much more complicated than regular folks like you and I, since he owns a lot of different businesses, and actually he was the first president to not make his tax returns available to the public. So we don't know the exact details, but according to the Times article, basically he was able to avoid taxes simply because his businesses were not profitable. In the past 15 years, he didn't pay any income taxes for 10 of those 15 years. Not only that, he has received money from the IRS, totaling more than $72.9 million in tax refunds. And obviously, we don't have hundreds of thousands to spend on resources to hire the best of the best tax experts to help us like Trump does. And most likely, we don't own a business that is losing millions every year. But we can take advantage of the systems in place to minimize the taxes that we owe each year. And the idea is simple. If you lose money on your investments, you can deduct your losses from your taxable income. And the idea is basically the opposite of what we talked about before. Going back to our example, let's say instead of making $1,000 on your investment, let's say you lost $300, and now your account is worth $700. Then you have the opposite of capital gains, which are capital losses. And you can deduct the losses from your taxable income. So if you made $50,000 as part of your regular salary, and you lost $300 on your investment, you will get back the taxes that you paid for the $300. But for individuals, the limit of deductible losses is capped at $3,000 per year. And if your losses were greater than $3,000, then you can carry over the losses to the next year. One thing you have to be careful of when you decide to sell your investments as a loss though, is that you can't sell your stocks on a loss and buy them back right away to try and claim the tax benefit. So in order to claim losses on your taxable income, you have to not buy back the investment for at least 30 days. Obviously, the goal of investing in the stock market is to make money. But it's also important to know the little details like this to maximize your returns. And that's going to do it for this video. Please consider subscribing with the bell notification icon turned on, and I will see you guys in the next one.